quiet tax trap, federal excise tax, leases, management structures, and audit readiness. Hello again. This is Forrest Owens. I'm an aviation lawyer, a private pilot, and an FAA licensed airframe and power plant mechanic. Finally, let's discuss the third major IRS issue, because this is one that often surprises otherwise sophisticated owners. Not all aircraft tax problems are income tax problems. Some are federal excise tax problems, and those problems often arise from management, leasing, reimbursement, and transportation structures, but without enough attention to how the flights are actually being provided. Large turbine aircraft are especially exposed here because owners frequently use management companies, charter affiliates, dry leases, interchange agreements, cost-sharing agreements, or fractional structures. Each of those can be commercially sensible. None of them is self-proving for tax purposes. Remember this, the tax law asks not who paid for the jet, but who sold the transportation. Under 29 U.S.C. Section 4261 imposes federal excise tax on amounts paid for taxable transportation by air. And the regulations emphasize that applicability is generally determined on a flight-by-flight basis. That single point explains a great deal of confusion in aircraft ownership. Parties often draft one elegant management agreement and then assume the tax answer follows the paper. But the excise tax analysis follows the transportation that was actually furnished and the amounts actually paid in connection with it. Congress created an important exception for certain aircraft management services, now reflected in Section 4261E, paragraph 5, and the final regulations in Treasury Decision 9948. Those authorities confirm that certain amounts paid by an aircraft owner for aircraft management services, such as maintenance and operational support, may fall outside the air transportation excise tax when they are not payments for taxable transportation. That was a major development for private aviation markets. But the exception is not a permission to skip for casualty structuring. It does not convert taxable transportation into non-taxable management merely because the invoice uses management language. IRS materials on air transportation and audit still emphasize that one must determine flight by flight what service was provided and by whom. The NetJets litigation shows how real the issue is. In NetJets Aviation Inc. versus United States, the dispute centered on whether amounts collected in the fractional and management setting were subject to Section 4261. The public record in this case shows exactly why aircraft owners should take these rules seriously. Large operators, sophisticated contracts, and long-running programs can still end up in litigation whether the service sold was taxable transportation. Another important line of authority is Executive Jet Aviation versus United States, where the Federal Circuit addressed taxation in the fractional aircraft context. You do not need to operate a fractional fleet to learn these lessons. The lesson is that once the structure starts looking like one party is furnishing air transportation for payment, the federal excise tax question becomes unavoidable. For large turbine owners, this frequently arises in four places. First, management company invoices that bundle flight services with support services. Second, related party leasing, where the lease exists on paper, but transportation is effectively being furnished as a service. Third, owner use of charter affiliates and repositioning arrangements where fees are not clearly characterized. And fourth, reimbursement models in which the parties understand the operation one way, but it is billed another way. That is why tax treatment, FAA structure, and operating reality must be aligned. A model that is non-commercial for FAA purposes does not automatically answer the IRS question. And a model that appears tax efficient on a spreadsheet may fail if the facts show that transportation was being sold. The practical strategy is straightforward, but it requires discipline. Map every revenue stream and every reimbursement stream. Separate true management fees from taxable transportation charges. Confirm who owns the aircraft, who used it on each flight. Confirm whether the flight is on the owner's own aircraft or someone else's. Reconcile the tax position to the operational documents, the dispatched records, and the invoices, and review the structure anytime the ownership, management, or charter relationships change. There is also a broader audit lesson here. In 2025, Form 4562 added a specific aircraft question for taxpayers claiming depreciation, requiring taxpayers to indicate whether they own, lease, or charter an aircraft. This is a small checkbox with a very large message behind it. The government is building cleaner visibility into who is taking aircraft deductions and under what model. So the final common IRS issue is not just one issue. It is the owner's failure to treat the aircraft as a tax system with multiple pressure points: depreciation, compensation, deduction, disallowance, and excise tax. Large turbine aircraft magnify each of those because the aircraft is expensive, the passenger profiles are sensitive, and the structures are rarely simple. Keep this in mind. I want people to remember the aircraft that creates the best tax result is usually not the aircraft with the most clever structure. It is the aircraft with the cleanest facts. Large turbine aircraft can be tax efficient, but only when ownership, operation, billing, payroll, and documentation are all telling the same story. That is what survives an exam. And that is what keeps an aggressive position from turning into a very expensive reconstruction project years later. In short, the common IRS issues in the tax treatment of large turbine aircraft arise because the aircraft sits at the intersection of business use, personal use, compensation, transportation, and proof. When those categories are blurred, the tax return becomes vulnerable, and the deductions as well. When managed deliberately, the aircraft becomes much easier to defend. Take this away. In large turbine aircraft planning, the winning strategy is not creative first. It is classification first. Thank you for your interest in this topic. This information is provided for informational purposes only and is not legal advice. Please direct any questions to admin@aviationlegalcounsel.com. We look forward to helping you navigate these issues with precision.